I can't stand the investors that over diligence a deal and drag the founder through the mud unnecessarily. They're disrespectful of the founder's time. If everyone thinks what you're doing is a great idea, it's probably not. If everyone thinks it's a bad idea, it might be. But if you have disagreement, if you have some people that are all over it and some people that think you're wasting your time, that's special.
Welcome back to Service First. I'm Ben Wiggins on behalf of Proclaim, and I'm here with Andrew Kazlow. Thank you for joining us today, Andrew.
Absolutely. Thrilled to be here.
Yes, it is our pleasure, and thanks for doing it while you're a little under the weather too. We appreciate you making the time anyway.
Well, hopefully it doesn't ruin your brand to hear a little coughing and hacking in the background.
You sound great to me, my friend. Icebreaker question. What is the worst service failure you've ever seen, other than the fact that I had not subscribed to your Substack yet?
I love this question. What immediately came to mind was actually a sales experience I had about 1.5 years ago.
Okay.
So I was starting into the market for a virtual assistant because I was starting to get overwhelmed and realizing that leverage is a thing as a business owner that I should be thinking about.
Sure.
Reviewed several virtual assistant as a service type companies and had a pretty clear idea for what I was looking for. On one of them, I won't name the company. On one of them, the sales guy gets on this call. Within the first 3 minutes, I've explained, here's what I'm looking for. Can you help me with this? Yes or no? Proceeds to completely ignore my questions, go back to his off-the-shelf, standard cookie cutter PowerPoint presentation, walking through the 12 benefits that their thing offers. I interrupted him to ask my specific questions 3 or 4 times, and he just was not having it. And after 20 minutes of feeling like I wasn't a person,
yeah,
I was like, I'm never working with this company. I know this guy's probably making $15 an hour, doesn't really care. But the fact that I had that first touch experience with this company just left me completely uninterested in ever doing business with them again. So I felt dramatically disserved as a potential buyer in that situation. And as a CEO, aka #1 salesman for my company, it just made me so mad that I was treated that way.
Yeah, I'm sorry you had that experience. You are the CEO, the founder and CEO of PitchFact, and you guys do some very impressive work there, and I've been the beneficiary of some of that work, so thank you. What drove you away, especially as someone who has an MBA? What drove you away from the traditional get an internship, go get a great, a well-paying job in corporate America? Like what nudged you away from that and into, oh man, I'm going to go take my own swing? Why?
So I started my career as an engineer, and I realized pretty quickly that the other engineers loved the technical elements and getting into the weeds on building the stuff and solving these specific analytical problems. And part of that was exciting to me, but I learned very quickly that what was more interesting to me were the big picture, strategic, kind of visionary elements. And so I knew that I was not a fit for the traditional engineering role. Mm-hmm. Found myself in a sales engineering job straight out of school. This was for a distributor for Emerson Electric, so kind of in the industrial automation space.
Yeah.
What I found myself falling in love with in the 4 years that I was in that role was the opportunity to work with customers to solve real world problems, not technical on paper, back in the weeds kind of problems, but with real customers doing real stuff. What's actually going to help them? And so over the course of my 4 years,
tore off your pocket protector.
Yeah, pretty much. So after 4 years, I realized that, hey, the 3 things that I enjoyed were the 3 products that I got to help build and take from idea on the whiteboard to product on the shelf. One of them completely flopped. Like it made no money. It was a huge loss. The other 2 were moderately successful to the point where I was like, okay, this is legit. Like, how do I do more of this? I need to go learn about business and strategy and finance and management, all of that to be able to build stuff like this more regularly. That's what took me to the MBA. And I've always since that realization, had this vision for building and growing entrepreneurial ventures, and just know that I'm not a fit for the big corporate America, hyper niche specific contribution. I love having a small plow that if I put my shoulder to can make a material impact in the space that I'm working.
Yeah. So PitchFact, pretty ingenious model. Pull back the curtain for us a little bit, if you would. Tell the viewers what you're doing and how did you get there?
So we started out, I was working during the MBA program as a volunteer student worker at a angel network associated with the university. In that experience, I realized, okay, these processes are longing for improvement. There is so much opportunity to make this better. I went and interviewed about 50 folks as part of my MBA capstone and learned two things really suck at the angel investing stage. Number one is due diligence. It's really painful, really difficult for the average investor and entrepreneur to go through. And then number two is the process of running these investor communities. It's oftentimes reliant on volunteers, students like I was in that case, and part-time, underpaid, underqualified staff a lot of the time. So I raised my hand coming out of the MBA program and was like, well, I'm not that smart, but I can probably help with some of this. Initially, we focused on the due diligence problem because I thought that that was the simplest, kind of easiest to serve. What I have since learned is that every investor needs a base level of information to make an investment decision, the 0 to 1. For the most part, angel investors don't really need all that much information. They kind of prefer to go with the gut. Now, there is a range. There's the gut, the pure gut investor, and there's the more analytical investor.
Grip it and rip it.
Yeah, he's going to lean on some of that analytical stuff.
Yeah.
But on average, angels tend toward the gut-driven mindset.
Mm-hmm.
And so what I've learned from that is that even though diligence is a pain point, it's more of a vitamin than it is a painkiller. What I've learned is the real pain for most of these investor communities is actually running their processes in a way that is responsive and efficient and consistent. It's really difficult when you're relying on part-time or volunteer folks. And so PitchFact's model is literally to be a service provider for early stage startup investment communities. So we provide a operator that serves as the face for the investor community's deal flow and operational processes. And then behind them, we've got a team of administrators, virtual assistants, analysts that help execute those processes. And so we do that on a fractional kind of as a service basis. And the business model is basically, here's your price. I can spread one set of those services across multiple communities, and our margin is the delta.
Makes sense. So in that process, like what's been the hardest thing for you to read or hear as a business owner? This could be something service oriented, or it could be, for me, the hardest things have been, we don't like the statements that really translate as we don't value what you do. So it could be something like that, or it could have been something else that you were like, man, shot to the heart.
I am 100% in the same vein. The hardest moments for me have been when I've been told this will never work. And those moments are hard because it's an ego challenge more than anything, because my immediate reaction is to go one of two ways. First reaction is typically, well, this guy doesn't know what he's talking about. They clearly don't understand what we're doing. But then the other side of me is like, oh man, are they right? And so those moments are incredibly challenging as a business owner. Like, am I wasting my time? Is this foolish, right? There's so much imposter syndrome anyway as a business owner, especially being younger, less experienced in a relatively new space.
Yeah.
And so hearing those kinds of things is always really difficult. There was one specific story where about 2.5 years ago, this was when I was kind of at the ideation stage for PitchFact, I presented the idea to a panel of random audience members at a event called the Raymond Ideas Challenge on
Yeah.
campus at Texas A&M.
Oh, yes.
Afterwards, I won't name who the person is, but someone came up to me. They're an experienced investor in the space. They're very active kind of in the energy investing world. Came up to me and basically flat out said, "This will never work. You should go work for this other presenter who has a good idea." That wrecked me. And yet, I've thought about it not every day, but at least monthly since then. And as I look back, while I hated that moment, I find myself feeling grateful because what he was hinting at is this reality that the diligence piece for many is a vitamin more than it is a painkiller. And so he was, in a less kind way than I would have liked, trying to push me away from building something that he genuinely felt like wouldn't be a huge need in this space, which I ultimately came to agree with him on. It just took me 2 years instead of listening to him and then and there.
Yeah, it's funny. I think, man, there's so much spinning around in my head as I hear you say that. So I guess first thing to say is I try not to tell anyone this won't work. Honestly, every idea has possibility, or has at the very least has possibility to pivot into something really meaningful. And one thing that I think we do a very poor job of as investors is knowing how much weight your words carry. It's like, when you're a kid, or even as a teenager or a young adult, when your parents are disappointed in you, or God forbid, when they're mad at you, that swings so much more weight than if somebody at school is mad at you. Like when your parents are mad at you, you're in trouble. And if they're disappointed or they think you did a bad job with something, that's stuff you can carry with you forever. Whereas, when you had some drama at school in 5th grade, you might remember 1 or 2 of those things that happened in your school life, but it doesn't sit nearly as heavy. And as an investor, these founders are coming to you not like children, but like people who need your help and who are not as far along as you are in most cases. And you expressing disappointment, and especially if you express disgust, or shame, or use shaming language, how could you think this was a good idea? That kind of stuff, that's just bad practice. It's bad business. It's a bad way to relate to people. And sadly, I think we as investors, most investors have some degree of introversion. I feel like I don't see a whole lot of true, super gregarious extroverts in the angel investor space for whatever reason. And so, those core skills, those interpersonal skills, sometimes can use some refining, and that is to the detriment of the investor community and the investment community, and at the pain and expense of the founder community. So we need to be better with that. And I think one of the things, if any investors are tuning into these regularly, I think one thing that we need to do better with is to be gentle with the feelings of the founders, and also to understand that you might be wrong, even if it's totally outside your investment thesis, to know that to some degree, every idea has merit, even if you think it cannot make any money as currently constituted.
Well, Ben, this is one of the things that gets me very frustrated about many investor communities, and that I think is a big miss for a lot of folks. There's 2 extremes when it comes to feedback. Extreme 1 is no feedback. You get nothing. I would rather get brutal, ridiculous, super painful, in your face feedback than I would get nothing. Or BS feedback, basically. The other extreme is to give way too much feedback, way too much detail, way too much analysis. That's less often what I see happen. Vast majority, probably 99% of investor communities tend to just not give enough feedback, not give any, because it takes time, it takes energy, it takes logistics. It is so hard to explain to an entrepreneur why their baby's ugly. It's so much easier to just say, it wasn't a fit. Thanks. So I actually feel some gratitude toward this investor. I would rather have received harsh feedback than no feedback. What I would say is the method of delivery reflects on you as an investor.
Yeah.
Okay. So if you don't care about being perceived as a jerk and as somebody that just is a straight, then fine, share it straight up. But I think the message is the method with which you deliver feedback, if you choose to, will make an impact and will get around, and you will attract or repel founders based on the reputation that you build. And the method in which you give feedback helps shape that reputation.
Yeah. Yeah. People remember the stuff that happened early. Like we all kind of have our horror stories as founders, and this, maybe not a horror story because there was some really good stuff that has come out of it for you. But when we were, when we started Proclaim, like I remember a few folks who scoffed at the idea. And then when we had really built out the product and started raising our prices, I remember a couple of clients and, people around the community who kind of looked at me like the message felt almost like, what do you think you have here? And this isn't like, you're just podcasting. And it was, you're playing, you need to go back to the little kids table was what the message felt like. And, I wish I could say that I've forgotten all those conversations, because that feels like the most, in accordance with kind of my faith and just sort of general good mental health practices, forgive and forget, right? Well, I feel like I've forgiven, and I don't feel like I've forgotten. And I'll see those people again.
But see, I think that can be a good thing. Like a little bit of in your face, a little bit of challenge, a little bit of disagreement from the market suggests that, hey, there's something here that a lot of people don't understand. I had a recent conversation with Dr. John Criscione. He's a biomedical engineering professor at Texas A&M. And he's built an amazing business called Coronova over the last 20 years. He has a deep held belief that if everyone thinks what you're doing is a great idea, it's probably not. If everyone thinks it's a bad idea, it might be. But if you have disagreement, if you have some people that are all over it and some people that think you're wasting your time, that's special. There's something unique there. And that concept has carried with me as well. So I think a little bit of challenge and in your face is a good thing. It's just sorting through where are the grains of truth and what's the underlying reality.
Were you the guy who introduced me to Alex Zarichta?
Yes.
Okay. Because Alex said something, and I won't yank the curtain all the way back, but he mentioned something about Y Combinator and the, kind of what kinds of companies get into Y Combinator, and something that you just said, it's not my truth to reveal. So I'll hold on, saying this publicly until I've talked to Alex about it. But Alex, something that you just said about who thinks the project, who thinks the idea is a bad idea, like there's a nugget there that is actually very important to Y Combinator. And the hint that I'll drop here is they agree. If everybody thinks your idea is a good idea, it's that you won't get in. So let's take this to the other side, though. We're talking about some of the tough moments. What's been the most triumphant private moment for you? And the way I like to phrase this is like, what has been your most ridiculous reaction to a piece of good news? Like when you hung up the phone and like jumped in the air, or like kicked back at your desk and like laughed at the ceiling, or, just something that you wouldn't do in front of your team. Like as founders, like it's, there are some of those moments have to be solo. Because it's not right to intrude on other people's space with those reactions sometimes. What's been your most ridiculous personal moment as a founder?
I think the most satisfying moment in my career at PitchFact was actually pulling off our first diligence report. This report took us like 2 weeks to prepare, probably 130 hours of work. And the night before we turned it in, myself and my 2 team members at the time stayed up all night, like literally all night long, to finish this report. We turned it in. I think the investors ended up writing like $50,000 investment. And afterwards, which is very low for the level of work that we did, afterwards, I went and interviewed everybody, and they were like, "Hey, this is amazing, but maybe next time don't do as much." I learned a lot from that experience, but let me just tell you, like, working on something for that long, giving such an effort to it, turning it in, and just being proud of what I had produced, that was one of the most satisfying moments in my experience at PitchFact. That ultimately did turn into a very first customer. We did a pilot with them, and then they signed on a full contract, and that was what really gave me the courage to start the company. But it all originated with deeply over-engineering and over-building for this very first deliverable. But I was proud of it, and my team was proud of it, and it's something that I look back on really fondly. That company is actually doing really well. Still, I won't name them, but they're doing quite well. And I've got 100 and something page diligence report on them. If anybody wants to see it, send me an email.
Fantastic. What was the service action that you've been proudest of from a coworker or a team member, somebody who's not you? Brag on one of your coworkers or team members for a second.
So my business partner, Keaton Savoie is his name. I have seen on, I won't give one specific, but on multiple occasions, this guy has been, for the first year or so of our business, he's been working part-time. He's got a day job. We just can't afford to pay him yet. That's actually changing right now, which I'm excited about. But he had been working a day job. This guy on multiple occasions has stayed up basically all night while working a day job to complete a number of diligence reports and service related elements. And so getting up in the morning and seeing an email or seeing Teams messages from this guy that was sent at 3 a.m. or 4 in the morning. On one hand, I'm clearly not stewarding time and attention very well if he's having to go to that length to deliver things. But on the other hand, I think it just reveals his dedication to our work and to serving the customer and to pulling things off with excellence. And so I think just that grit and hustle is something that I really admire and appreciate about him.
Good job, Keaton. Good bull. Andrew, what are some of the other trends that you're seeing in the investment space, especially in the early stage ecosystem?
Yeah, so let me break down the early stage ecosystem into the 2 categories that are relevant for me. There's angel investors and there are venture capital investors. The main difference between the two is that an angel investor is somebody that's writing a check personally into a small emerging company. A venture capitalist is possibly writing checks to those same companies. What's different is that they are not writing from their own balance sheet. They have actually gone out and raised capital from other investors, which are called LPs, limited partners. Those funds get pooled, and then this general partner who runs the fund is going to invest those dollars on behalf of those investors. And they're compensated based on the performance that they deliver. So that's the big difference.
Is that typically through carry, or is it through fee for service, or what's?
Yeah, the primary method for compensation is generally through a carry. There's a basic kind of industry standard structure for a venture capital fund where the general partner receives a 2% fee on the total dollars raised, and then they receive a 20% carry on returns generated up above a certain threshold. So once investors have received their money plus some amounts, after that point, the general partner will receive 20% of all additional profits. So there's huge upside, and it's a very well-structured, well-defined incentive system that's developed over the last 70 years since venture capital really has emerged as an investment mechanism. So that's a breakdown of the two types. Check sizes are also pretty different a lot of the time. A VC might write very small checks, but typically small for a VC is going to be 100 grand, maybe 250 grand, because they will have raised 5 million, 10 million. Those are very small funds. Average fund size is going to be in the 50 to 100 million dollar range. So angels on the other side are going to be writing checks. 25 grand is kind of average, but it can go as small as 5 grand and then 100 grand plus, depending on the investor. So that's a quick breakdown on angels versus VCs.
Yep.
A couple of trends that I'm seeing right now that are exciting. One is the average check size is decreasing for the average angel investor. What I mean by that is that portfolio theory is taking hold for the typical angel. Portfolio theory says that basically you need 15 to 25 companies in order to generate a successful return. The reason for that is that venture and angel investing is all about getting in on the winners. It is not a normal distribution. It is a structure where one company is probably going to generate all the returns for the portfolio. They're going to be an Uber or an Airbnb or something like that, go to the moon and generate crazy returns. Everything else is going to be 1x, maybe 2x, maybe nothing. Most of these companies are going to fail. And so the key is to not miss out on the winner. Many angel investors historically have gone with this hyper-focused approach where they'll invest in just a couple of companies and then be done. There's a tremendous amount of risk associated with that strategy. And so I've seen a broader adoption of this. Okay, I need to be thoughtful and strategic about how I allocate my dollars, make sure I'm getting in 10 to 20 companies. That's exciting to me because I think it will overall boost the performance of the asset class over the next few decades. One of the other things that is happening right now is that a lot of the dollars in the venture ecosystem, including both angel and VC dollars, are locked up right now. The IPO market is terrible. If we look at the last few years, very few companies that are venture-backed have gone public relative to 2020, 2021. And so there's a tremendous amount of value that is currently trapped or illiquid in these companies. I am excited and hopeful for that to change because over the next few years, if the IPO market, if the acquisition market becomes more active, that's going to create massive returns for the venture ecosystem that will help correct some of the poor performance that is often talked about right now because there will be return scenarios generated. So there's a couple of things that are happening right now that I'm tracking pretty closely.
Yeah. What is, if you would, talk a little bit about and then we'll get to the bone to pick question. What is functionally, what is the difference between an angel syndicate and a VC firm? Like, because I see on the angel syndicate side, I often see hurdle rates and carries and so forth being talked about there, which sounds to me like it's kind of, they're functionally sort of converging. What are the differences?
So a syndicate is similar to VC. The big difference is that a syndicate will not raise capital on the front end. So a VC is going to go fundraise to 100 LPs that are going to put in 100 grand each. They're going to build their fund and then they're going to go deploy dollars from that fund. A syndicate skips that first step. A syndicate finds a deal, shares that with their potential investors. So maybe there's a small fee to be a part of their syndicate and have access to their deal flow. But then each individual member of that syndicate has the option to invest or not. So a lot of the time the syndicate lead, kind of the name that's the partner there or the leader there, the face there, will commit to, hey, I'm investing X dollars. If you would like to participate alongside me, here's the minimum check size. You can choose to do so if you would like. So it's kind of a hybrid between an angel on their own and being a part of a fund.
So they're pooling at the deal level, basically, rather than pooling at a more diversified fund level.
Yep, that's exactly right.
Okay, makes sense. All right, now you and I play a lot in the LinkedIn space. We spend some time there, but this question is not limited to LinkedIn. Certainly, who do you have a bone to pick with right now? Who's doing something you don't like to see? What are trends that you hope do not continue?
Two things come to mind on that question. One is, I mentioned this earlier, and that is the investor community that fails to give feedback to an entrepreneur. It's hard to do. I sympathize with the investor communities that don't, because I help run a lot of these communities. It's very difficult. It's time consuming to do. And that's one of the things that we help our clients with, because they realize the importance of being responsive and honoring the founder's time. Another thing that I can't stand is the investors that over diligence a deal and drag the founder through the mud unnecessarily. They're disrespectful of the founder's time. I have a very high respect for the entrepreneur's time and attention. I am an entrepreneur, and I realize how expensive an hour is. Right? It might not seem like it's expensive because this company has no revenue and they're very early stage. What do you mean your time is valuable? Oh my God, it's valuable. There are a million things on my plate right now. And if you're an investor interested in my company and you're not actually intending to invest, but you're going to drag me through a diligence process that is going to take months and months, and you're ultimately not going to make a decision. I understand if you're genuinely interested and you discover something in diligence that leads you otherwise, but I see so many investors that just drag on the DD process because they don't have the guts to say no. And I hate that. I can't stand that. Say no quickly and everybody will be better off. So much time put to better use.
Yeah. Yep. I hear that. All right. So final question, 10 words or less. What should people start doing in service?
I think the best service providers already do this, but if you're not, customer discovery. 2 words.
Okay. Yeah. So let's expand on it just a little bit. What is, for our viewers who may not be familiar with the concept, what is customer discovery?
Customer discovery is sitting down with a number of potential customers or real customers and basically asking them what sucks, understanding what is painful to them without proposing, without pushing a solution, right? Very intentionally keeping your product or service, all of that off the table. Doesn't matter. No one cares. What is important is their problem, because no one pays you because your thing is great. Everyone pays you, no matter what service you're delivering, because they have a problem they need solved. And I see so many founders, entrepreneurs miss the mark because they don't understand the problem deep enough and they build the wrong thing. I've done this myself. I wish I would have done more to customers. I interviewed like 50 people and I wish I would have done more. Service providers and any entrepreneur must do customer discovery in order to build effectively, both at the start of their business and ongoing. Continue to talk to current or prospective customers. What's your problem? What sucks? Help me understand what's painful.
If you want to learn how to do this well, viewers, I've only read one good book on customer discovery. And Lean Entrepreneurship, there's some sections in their books that they devote to customer development and market development. And frankly, I think they do a bad job. I think Lean Entrepreneurship has a lot of value to add to the community, but that particular aspect I think is bad. The only good book I've ever read on customer discovery, customer development, market development is called The Mom Test by Rob Fitzpatrick. And it's great. And there is definitely a lot of art and a little bit of science to this as well. So great recommendation, Andrew. Thank you for that.
I'm glad you said that. If you didn't say that book, I was going to say that book. It's a short read. It's totally worth the $5 and 45 minutes to skim it.
Yeah, absolutely. Absolutely. It's a business Bible for me. And I feel like, in 25 years, my hope is there are 10 good books on it. But right now, 1. Okay. Well, Andrew, how can our viewers keep up with what you're doing? How can they subscribe to your Substack that I am now subscribed to? How can they keep up with you?
Yeah, best way to keep up is to hit my Substack. It's called The Diligent Observer. You can subscribe and you'll get access to my podcast. I share my thoughts, things I'm thinking about every Thursday. And another way you could stay in touch is hit me on LinkedIn, Andrew Kazlow. And I'm kind of active on Twitter, but just hit me on LinkedIn and Substack.
Fair enough. All right. To our viewers, thank you so much for tuning in. I'm Ben Wiggins. This is Andrew Kazlow. On behalf of Proclaim, this is Service First. We will catch you on the next one. Thanks so much.